Okay, so we'll start here in the middle. All right, so we're talking about credit. So you do have, there are industries that are more subject to leverage buyouts than others. Where I worked at USA, they made a mistake in 2008 where they're avoiding those sectors that had leverage buyouts, and they preferred sectors that didn't have that exposure. Well, the problem was the most protected sectors are the most regulated ones, which is like banking. Do you think you want to be over allocated to banks in 2008 during a financial crisis? So USA had one of their worst years ever in their mutual funds. Their mutual funds used to be just consistently top #1 in fixed income, but they had a horrible 2008 because they're just in the wrong sectors. So if you have a banking crisis, being in the banking sector is probably not the place you want to be. No, Phoebe?
But industries that are often bought out by PE firms have higher risk because they do leverage buyouts.
You see a lot in retail. Boy, I'm trying to think some of the big ones. You could probably go on to Bloomberg and get a list of them because they'll specifically, there's an MA function in Bloomberg that shows mergers and acquisitions. And you can probably sort by leverage buyouts and see which one are heavy debt. You don't see it in my industry in banking and insurance just because regulators just will not let you do anything. You know, you look at someone like Dell when they go under, that was more of a founder, just sometimes they're probably legitimate. He just wanted to get away from the market and fix his company and come back. So it depends. Burger King was somewhat of that, where I think, have y'all eaten at Burger King in the last 5 years? Anybody? I haven't been to one in forever. I can imagine their hamburgers because they have that distinctive smell. But Burger King went private and came back out. There was a lot of debt associated with that. Yeah, I'm not an expert on history of leveraged buyouts, but I'm sure you can find some good books. But Barbarians of the Gate is an interesting one because it really shows when you're making financial decisions entirely or to pad the pockets of investment bankers and make CEOs happy, where they're destroying employment and products. It's just a really horrible story. Bond investors hate these because this is something that comes out of left field and it just completely wipes it out, and they just have to take what they can get. All right, so here's how you can break it up. You can have the risk-free rate rising or the risk-free rate falling. These are treasury rates. You can have spreads widen or spreads narrow. So the most likely are the ones in blue. So the risk-free rate rises and spreads narrow. That's a strong economy. That's where you know, everything's just cooking, everything's going well. So corporate bonds are a good buy because the economy's strong. They're less likely to default. So spreads narrow. You're not getting paid as much for the risk, but interest rates are rising. So that's somewhat what we saw. Really the last, well, other than 2008, most of the last 30 years. The other one is the risk-free rate falls, but spreads widen. That's the recession scenario. That's what you saw in 2008. In the previous recessions, that's a pretty common one, other than the 70s. In the 70s, we had a recession and we had rates rising, but normally in recession, rates fall. So those are the two most common ones. The unusual ones really are all related to the 70s. Interest rates, risk-free rate rises and spread widens. That's the 1970s. Weak economic growth, very sluggish economy. That was where I was going to high school and then going to college. So we were pretty depressed coming out of college because it just looked like the U.S. was just not going to ever be great again. It was all about Japan. Everybody's talking about how great Japan was and how the U.S. was just old school, never going to compete. Pretty depressing time. And then the 80s came and it was just the opposite. Interest rates fell and spreads narrowed. That was in 85 through 1990. You couldn't lose money. You'd have to try really hard to lose money. Everything was up double digits. Bonds were rallying, stocks were rallying. Everything was just great. Why? Because we fixed the inflation from the 70s and everything just recovered. I probably won't give you one of these scenarios in the exam on the second question. They're just too unusual. I might have different degrees of this. I might have spreads narrowing, but interest rates staying about the same or not moving much. It's kind of hard to say. I don't always give my scenario in that second question. Sometimes I go out and steal somebody else's just so I can give you a little bit of variety. I'm running out of scenarios I can give you, but I'm trying to give you something that is reasonable. I'm not going to give you something really out of left field. So one year, so when I was at USA, we started this asset group where we started writing an article every Friday. And that was my job, write the article, and then Cliff would edit it, and we'd argue back and forth. And then we published it out there. So one year after I retired, I just stole that article and made that my exam question. So John Spear wrote it, and I went and just stole John Spear's and just gave that to you. So I'll try to find something that's realistic, that's out there. But most likely it's going to be something in the neighborhood of spreads widening because the economy is weakening. So interest rates are probably going to fall, which is one thing you can certainly emphasize in your paper one. One advantage we have if we have a recession is that the Fed has been raising rates. And so rates are high enough now that they can actually cut them. There was some concern a few years ago, if we had a recession and interest rates are like 1%, what's the Fed going to do? How do you solve a recession when you can't cut rates? So at least we have some room to cut rates. So this scenario is back on the table, definitely. This one's possible. Let me give you my argument for why I don't think spreads real narrow. And that's where spreads are today. So I updated my OAS spreads. So these are updated numbers. So let's look at single A. On average, single A give you 120. So it's a 10-year Treasury yield is 4%. What is a 10-year single A corporate going to be yielding? Someone yell it out. 5.2%. Thanks, Luke. 5.2%. Is that enough to compensate you? Would you put all of your money in that one bond to make 5.3%? Would be very well diversified. But if you had 50 bonds making 5.2, that's giving you something over treasuries, 5.2 versus 4. If you knew they were all going to mature and not go bankrupt, you obviously would do the 5.2 instead of the 4. But you have to ask, how many single A bonds go default over the next 10 years? It's about 1%. About 1% of those will default. But even if they default, you don't lose 100%. On average, if a single A defaults, you'll get about 50% of your money, 50% of your money back. So you have to take that. In my risk management class, we go through all that math. Generally, bonds pay you a pretty good spread relative to what you're likely to lose by default. So 1.2%. But where is that spread today? What would be the 10-year corporate today, Luke? There's 4.8. Is that enough to induce you to buy corporates? You might say, you know what, I might as well just buy the stock market, or unless you think the stock's overpriced. So you're not getting paid much. What's scary to me is a high yield. And you'll see why I don't like high yield right now. The average is 489 basis points. Today, you're only getting paid 3%. Anywhere 15, 20% of those are in default. And you'll probably only get about 20, 30 cents on the dollar back. You're going to lose, you will lose money on high yield. I don't think I wouldn't be doing 3%. I don't want a 3% spread on high yield. I don't know who's buying high yield. Plus, we're in a time where there's a lot of uncertainty. It seems like a lot of danger. Boy, that is crazy. And the low was 268. I'd be tempted almost to short high yield at 260. Find some high yield ETF and short it, because at 268, you're not getting paid at all. You're hardly getting paid just to cover you for a default. If you go in a recession, that's going to just absolutely be just disastrous. So I showed y'all in the 2008 crisis, that spread went up 9 times higher than it was just a couple of years ago. So AAA doesn't pay you much, but AAA, the chance of a AAA going default next 10 years is extremely low. But anyway, it's all spreads right now are just very, very low. They're not at their all-time lows, but they're getting pretty close. That to me is a little scary. Why is the bond market telling us there's no risk anywhere? We know there's risk all over the place. People are talking about potential recession. We're talking about, you got potential for war. You got Ukraine, what's going on in Gaza. You got Taiwan. there's a lot of stuff going on, and yet the bond market's telling us this is about the lowest risk environment we've ever had in the history of the US. It doesn't feel like it to me. So I'm not a big fan of corporates. I'm actually buying treasuries right now just because their yields are actually pretty good, although now they're dropping pretty fast. But locking in those treasury yields at 4.5%, 5%, it's just not a bad investment. I wouldn't have done that 3 years ago, 4 years ago. So right now, this spread's narrowing in a strong economy. I don't know how much more they can narrow. So I don't know how I'm going to put that on the exam. So maybe I'll just have to give you a recession, so I don't have to worry about that one. All right, I'm not going to do any more of those examples. You can read them in the class notes. All right, questions on credit. So you can make your career on credit. I know a lot of people, that's what they've done. My best friend is a credit analyst. He started at USA, worked in the bank and became a bank analyst, and now he's doing energy over at Victory Capital. Like, I keep track with those people. So you can do corporate side. There are muni bonds. I'll talk about muni bonds here in a little bit. And then you have the guy up in Austin, Hoisington Capital, Lacey Hunt. They do nothing but treasuries, and they just bet entirely on interest rates. But you can become a credit analyst. Credit analysts get paid just as much as stock analysts. It's the same job. It's just, it tends to be less stressful of a job, except for in a crisis, and then it's more stressful. So in 2008, bond guys were far more stressed out than stock. Stock people were used to markets falling 30%. It's like, okay, that happens every few years. We're used to it. The bond guys, what happened in 2008, they never seen that before. It was just, they were completely blown away. So, but at a bond investor, your life is pretty calm, pretty stable, and there every once in a while it's just total mayhem. Stock investors is pretty bad every 4 or 5 years. We get used to it. So, all right, let's talk about the U. Really, the U means US, but I really what I mean is non-US stocks, non-US bonds, international bonds. So let's say US bonds are paying 5%, but you can go to France or Germany or Turkey and you get a bond that's paying 7, 8%. Maybe you should do that. What do we introduce when you buy international bonds? Now you got currency risk. So now if you're going to do international bonds, you got to ask, what's the risk of the bond versus the risk of currencies? And most people in the US, most investors do not buy non-US bonds because of currencies. Because the risk of bonds is this big, the risk of currency is that big. When you buy a non-US bond, the currency is just going to take over. You're going to feel like if you invest in Japanese bonds, you're really buying the yen. And that's what you're going to notice is the yen going up and down. You're not going to notice the bond so much. So most people put non-US bonds as an alternative asset and not part of the bond portfolio, just because currency risk is so massive. Now, you might say, well, I know what I'll do. I'll buy Japanese bonds, and then I'll hedge out the currency risk. Well, if you do that, you're really just buying US bonds again. It doesn't really change much. So the currency risk is based on what? When do currencies strengthen or weaken? Inflation causes currencies to weaken. Interest rates falling causes currencies to weaken. Big deficits, trade deficits, fiscal deficits. Japan obviously has huge fiscal deficits and low interest rates. So the yen has just been really weak the last several years. I don't know if I can show you the yen. I can't remember. Yahoo Finance is so horrible now. It used to be my go-to spot to get quick data, but they found a way to try to get people to pay for it. And I don't want to pay them any money. That's too much. So you see how much it's just weakened. And then you saw, let's do 1 month. Then you saw the Bank of Japan. So, I mean, I know I talked about the yen strengthening. weakening, strengthening. So you see how much it's strengthened. So here's where the bank came in, right? So but strengthen, but it's weakened here recently. But you certainly see the long term, I'm gonna go back farther than that. Long term weakening. Very low interest rates. Extremely high deficit. We worry about the deficit in the US, but in Japan, it's much bigger. It's a much bigger problem. And what's the other problem in Japan? Demographics. What's happening in Japan? They're aging, right? Japan is getting really old. It's a really tough place. So the currency is weaker. Be a great time to go to Japan for vacation, even though it's maybe come back a little bit because you get a lot more yen for the dollar. So that's a huge risk for you as a bond investor. You might want to buy Japanese bonds now because you think the yen's going to strengthen, but if that's the case, you probably should just buy the yen. Don't even buy the bonds, just buy the yen and then bet on the yen. So if you buy non-US bonds, you're betting on the currency, which really means you're betting on that country's inflation and interest rates. So you can't just buy another country's bonds without having an opinion on what their inflation and what their interest rates are going to do. And the key is not what does their inflation do, what do the rates do. The key is what do the inflation and rates do relative to what's priced into the currency. So it surprises. If their inflation comes out higher than expected, you're going to lose on their currency. If their inflation comes out lower than expected, you're going to win on the currency. So that's the key. A friend of mine asked, he's from India. He said, hey, I can buy 10% CDs in India. I said, yeah, that's because everybody's expecting inflation in India and expecting the Indian currency to weaken. So if you go and buy that in dollars and convert it to Indian currency, if everything works out as expected, then when you convert it back to US dollars, you end up making the same return in US because what you made by making 10% of the CD, you're going to lose when you convert back on the currency. So the key is really, what do you think is price for interest rates and inflation? And if you expect it to be better or worse, that's where you want that. So you're really not buying bonds, you're really investing in currencies. You can try to pick up lower quality by going to emerging markets. So GMO right now really loves emerging market debt. I don't touch emerging market debt because I don't really understand it. It's kind of a scary. I mean, do you want to be loaning money to Venezuela right now? There's some pretty difficult countries right now. I don't even know if Venezuela is even in emerging markets anymore, but you got to be really cautious because those are some blow up stories that might hit you. So most people consider these an alternative asset class. There are probably ETFs that do, or exchange traded funds, mutual funds that do international bonds. You probably can buy them, but just be aware it's going to be much more volatile than a typical bond fund because currencies are going to drive that. On the inflation side, we may talk more about inflation here. Currency risk, you can measure at the purchasing power parity. You can get that, and Bloomberg has the PPP. You can look at it, and it'll show you which currencies are overpriced or which are underpriced. And you might think, why don't I just short the currencies that are expensive and buy the currencies that are cheap? The problem with that is the currencies that are expensive have been expensive for decades. And the currencies that are cheap have been cheap for decades. So, you can do the Swiss franc because you can short the Swiss franc because it's expensive, and maybe 30 years from now you'll win on that trade. But that currency has been up there for quite some time. The Big Mac Index is another good one. Here's an article from Big Mac. So the economists created the Big Mac Index. When they wrote it, it was a joke. They were kind of tongue in cheek, this Big Mac Index. And it was so popular, they've had to keep it around. But the reason I did the Big Mac, what are you trying to do? So purchasing power parity is what they're asking is, I shouldn't be able to take $100, convert it to Canadian currency and go to Canada, buy stuff, come back to US, sell it in dollars and make a profit. So currencies should be equal between countries. But the problem is every country sells different things except for one product. What's one product you see everywhere? The Big Mac. When I was in Greece, I went to the Olympics as a spectator to the Olympics in Greece. And Greek food was really good for like 2 meals. And then I couldn't take it anymore. All the oil I just couldn't do. It was really good. And then we went to McDonald's our last meal in Crete. And it's kind of depressing that right across the street from the Pantheon is a McDonald's. So you can walk out of the Pantheon and walk to McDonald's. So you're in this building from thousands of years ago, and you can go to McDonald's. But they had Big Macs. Why did I go to McDonald's? Because it looked exactly the same in Greece as it looked in the United States. So what they said is you shouldn't be able to go to Canada, convert your currency to Canadian currencies, buy a bunch of Big Macs, come back to the United States, sell them in the US and make money. They should be in the same price. And so what they do is they look at a McDonald's. So they say the Swiss franc is 35%, 38% overpriced. The Colombian peso is 12% underpriced. That's all based on that conversion rate of Big Macs. Now, could you actually go to Canada, buy a million Big Macs and bring them back to the US and sell them? I would guess most people, you'd have a tough time setting that up and selling them. So it's a little bit, there is some friction. You got workers, you got to get, there's supplies that show up. So they admit there's some issues with this, but it's one of the best products they can find. And you can see what's overpriced and what's underpriced. In US is the base currency, so everything's priced off the base currency. So could you sell the Swiss franc and buy Colombian peso and have that work out for you over time? I don't know if I've ever seen this chart where the Swiss franc wasn't at the top. It's always up there. I don't know why, what the Swiss are doing. So don't go vacationing. I do want to go vacationing in Switzerland because they have some really nice bike rides, but it's going to cost me 38% more to convert and stay in their hotels. This one is out of Bloomberg. This is purchasing power parity, where you can see the Swiss franc up at the top, the Russian ruble. You see all these all over the place. So all you have to do in Bloomberg is type PPP, and it brings up all these charts that are really, really interesting. So the Swiss franc, 38% overvalued. I don't know what it is today. I don't remember when I even loaded this. All right, so that's it for international bonds. At USA, we talked about starting a non-U.S. an international bond mutual fund, and Cliff, who's the head of the department, said, I'm not going to do it. He didn't want to have a bond fund that looks safe because it's high credit quality and customers buy it and then it's really volatile because of the currency. So he just didn't want to touch it. It's just too dangerous. So, think about it. I was responsible for our London office and our German office. And the bond people managing those portfolios, they called me and begged me to get rid of that because those markets were open 7 hours earlier and they didn't want to get there at 2 a.m. So we hired a manager in London to manage all of that. And I gave him currency targets to manage our book of business based on where we're going to be paying out our claims. It's a small portfolio. I don't think it was even $70 million. Really small portfolio, but we were so desperate to get rid of it. And so I did them a favor and give it to this guy. You want to guess what his degree was in? You tell someone to manage currencies, what do you think the college degree is in? I think I heard it. Say it loud. It's not finance. Economics, right? He had a PhD in economics. You'll see that a lot. People who manage currencies are economists. Why? Because they got to understand Fed policy, interest rates, inflation. They got to understand deficits, trade deficits, fiscal deficits. So he was an economist. So it makes a lot of sense. All right, T for taxes. So in the US, our tax code has a special type of bond that is excluded from federal income tax. And for states that have income taxes, they may also be excluded from state income tax. And so a lot of, not all, but a lot of municipal bonds are tax-free at the federal level. And so California and New York have state income taxes. They're tax exempt in those states, but only if you buy the right type of municipals. So you have to buy California municipals to get tax-free in California, and New York municipals get to be tax-free in New York. And so what you'll notice with a lot of bond funds is they won't just have a tax exempt bond fund, but they'll have a New York tax exempt bond fund. for people living in New York. So these bonds are tax-free at the US level and at the state level. In Texas, it doesn't matter because we don't have an income tax, so we don't have a Texas Municipal Bond Fund. So how do you make the choice between, are you going to buy municipals or buy corporates? The corporate bonds are taxable, municipals are not. So your uncle comes and says, hey, I want to buy some bonds. I don't want to buy treasuries because I want to pick up some spread. You say, well, you could buy municipal bonds or you could buy corporate bonds. They're both the same credit quality. We'll buy you some single A and triple B bonds. So, well, which should I buy? Well, the first question you're going to ask them is, well, what's your tax rate? What's your marginal tax rate? Is it 10%? Is it 20%? 30%? It's easy to find that. You just get his adjusted income, and whatever that tax rate is for that tax, you can get it off the tax rate. That's its marginal tax rate, and that's what you use for the analysis. And essentially, what you're going to do, I had one professor here upset that I teach it this way. I agree that the way I'm teaching it doesn't make sense, but it's the way it's done in practice. So I'm going to teach you how it's done in practice because that's what you're going to see. So if I were doing this, I would take corporate bonds and multiply that yield by 1 minus the tax rate. I'd bring their yield down so I can compare it to municipal bonds. But that's not how it's done. All right. How it's actually done is they take municipal bonds and divide it by 1 minus the tax rate to bring their rate up to corporates. So essentially what this say is, how do you get them equivalent before you pay tax? All right. I know it doesn't make sense, but that's the way it's done. It's called the tax equivalent yield. You take the tax exempt yield, not the corporate. Corporates are taxable. Take the tax exempt yield and divide it by 1 minus the marginal tax rate. On the exam, I give you the marginal and the effective tax rate. You don't care about the effective tax rate. That's your average tax rate on everything. We're talking about a marginal decision. Your tax on the next dollar, use the marginal tax rate. So you take a tax exempt yield and divide it by 1 minus marginal tax rate. So these are actual numbers from a year ago, or I might have updated this summer. I don't remember. So intermediate taxable fund has a 3.2. Oh, this is some time ago. 3.27%. The tax exempt is 2.82. If your tax rate's 25%, you don't do anything with 327. I see several students on the exam. They take both the tax exempt and the taxable and divide it by 1 minus the tax rate. You don't do that. Only the tax exempt. So you take the tax exempt, you divide by 1 minus the marginal tax rate, you get 376. You compare that 376 to the 327, and you tell your uncle you're better off buying the tax exempt bonds because they have a higher tax equivalent yield than corporates. Assuming those are the same duration and same credit quality. I can't compare a 2-year bond to a 10-year bond or AAA to a single A. But let's say these are both single A quality, 5-year duration. The only difference is how they're taxed, and you pick the one with the higher tax equivalent yield. Okay, very, very straightforward. So here, I guess I updated it to February. The taxable was 409, tax exempt was 324. Take 324 divided by 1 minus 0.25, you get 432. The tax exempt is still higher. We want to do this with real life numbers. We can try that. I use the US ATX. This is a tax exempt. What word you see there? Intermediate, right? Remember that Vanguard created this short-term, intermediate, and long-term. You use those in bond funds. This is the intermediate. It's tax exempt, and its yield is 325. So taxable intermediate, and here we're talking about corporate. Why corporate? Because we can't compare municipals to treasuries because treasuries don't have credit risk. Municipals do. Municipals, just like any other bond, they have your AAA rated, AA rated, single A rated. So let's say that is 4.8%. Let's say your tax rate is 30%. Tax equivalent yield is going to be 0.0325 divided by 1 minus 0.3. So what would you recommend your uncle do in this case? The corporate or the municipal? corporate, a little bit higher yield. Right. Pretty simple. At USA, that was my job for the longest time, is I would figure out what our marginal tax rate was, and I would send that to Donna. And she would figure out where she's gonna buy municipals. She didn't buy municipals in the reciprocal company because it was tax-free. She would do it in the taxable firms, but she'd make that decision between municipals. And property casualty insurance companies like USAA, they buy a lot of municipals. They're probably the biggest buyers of municipals. They buy a lot of them. Probably more than any other buyer, maybe even more than mutual fund companies. Let's see if they give us a yield. So the yield's 4.73. I wasn't that far off. So you still prefer the municipal bonds in that case. So Vanguard's a great example of they're following exactly our template on how they define markets in different categories. But very, very straightforward. That is something you could right now help your uncle with. They're trying to decide between municipals and corporate. So they want to buy some bonds. This helps them a lot. Then you got a question, do they do short-term, intermediate, or long-term? So if you think rates are going to fall, then you would do long-term. So you have that question as well, but you can see Vanguard is going to help you with that. Once you decide what your uncle is going to do, say, okay, well, you want to do intermediate term. We really don't know if rates are going to rise or fall. Let's do intermediate term. Let's get the yield on intermediate term. Let's get the yield on taxable, tax exempt. What's your tax rate? Within 5 minutes, you can have your uncle exactly where they need to be in their portfolio. All right. Structure. All right, so structure, we could spend the entire semester just on structure. This is what finance gets really, really creative. It's pretty amazing what finance has done. They've probably invented stuff we didn't need invented, but they have invented some really good stuff. You may have heard the term financial engineering. This is when the PhDs in math started working for banks and investment firms, creating whole new categories. And what they decided to do is say, let's take a bunch of bonds and let's start stripping out the pieces. Let's give some of the pieces to people over here. We'll just give them the interest on the bonds. Here we'll give the principal. Here we'll do a really protected, high quality class, but we'll do a really lower, higher risk class, and we'll pay them more. Just splitting stuff up. And they've created this alphabet soup. CLO, collateralized leverage obligations, PACs, preferred, amortization class, IOs and POs. Well, you talk about getting crazy, and IO is an interest-only bond. So that means you buy a group of mortgage-backed securities, but all they send you is when people make interest payments. What happens when interest rates fall to those interest payments? They go to zero because people pay off their debt. That's a pretty dangerous bond, isn't it? If people refinance their debt, your interest only is going to go to zero. Pretty dangerous. What's the PO? Anyone I guess on that one? Principal only. What is that? They take a bunch of mortgage-backed securities, but the only cash they send you is when people are paying principal. So there, if they prepay the mortgage, you get a bunch of cash. So very, very dangerous bonds. Collateralized debt obligations. And then they have CDO squared. So CDOs is banks take not their mortgages, but they take their corporate loans that they do to small businesses and they put them into a pool. And then they sell those off and you're buying a pool of these bonds. And then CDO squared is a CDO that contains a bunch of CDOs. It's almost impossible to know what you have your hands on. It's really complex. CMBS is commercial mortgage-backed securities, but there's a bunch of other ones. They're all over the place. Some of them, like PACs, were created to reduce risk. So a lot of banks would buy PACs. PACs are mortgage-backed securities, but they're protected from prepayment risk. So what they say is you can buy a mortgage-backed security, but we'll create another bond and they're going to get all the early payments so that you won't have to worry about all that prepayment. So you're protected from that. So that's what a PAC does. But a PAC's going to have a lower return because of that protection. So these trusts are putting these together as the engineers are looking at it, and they're essentially just what they're doing is carving up the cash flows. They're called tranches. They carve up the bonds, they carve up the cash flows, and they just repackage them to whoever wants to buy them. Higher quality, lower quality. It's well beyond the scope of this class. but you could spend your entire career on just one of these. So at USA, Victory Capital, Trey, good friend of mine, Trey, all he does is CMBS. And he could sit and talk to you about CMBS for 3 or 4 days and you wouldn't even be close to what he knows. It's just amazing what he can do. Pretty exciting stuff. These things got grossly mispriced in 2008 because people saw that mortgage and they tied it to US housing market. These things sold off dramatically. And there's a group of people at USAA, they're going around and saying, you want to give us like $300,000 for starting the fund, we're going to buy these things. And they could never get it together. These things are up like 70, 80% in 2008, 2009. Really high quality. And that's the thing he did. He said, okay, I'll look at these bonds and I'll look at all the real estate that they're holding. This is commercial real estate. And what's the worst case scenario for this bond? And the worst case scenario, the bond would still make a high return. In the worst case scenario, and they're like, we got to buy these bonds. So you specialize in these and that's all you do. And you're set for life in your career as long as you enjoy it, because you know so much about that one thing. And there's going to be people all over the place buying these bonds. So once you get that expertise, you just, you go to the next highest paying job and just keep moving around. These bonds, so for the exam, what I need you to know is these bonds are more complex. They're often less liquid, so they do tend to pay a little extra yield for liquidity. So you better know what you're doing, better understand them. These bonds are notorious for you needing to run a bunch of scenarios. Like on the CMBS, CMBS, you're getting 50 loans in one bucket. What Trey does at Victory Capital, what Trey does at Victory is he goes in and he delves into every single one of those properties. He looks at where they're located, what their current market value is, what other properties are. He does a deep dive on all those 50 properties. So he can make sure he has good collateral for his debt. So he can look at that worst case scenario and make sure he's going to get his money back. These kind of scare you, but they should excite you as well. Because if you walk into one of these careers, after about a year or two, you're going to get it. At first, you're going to feel so stupid, which is when you know you got the right job. But the first week on your job, you feel really stupid. You're in the right job. Because you don't get paid a lot for easy stuff. You get paid a lot for complex stuff. But just think 2 or 3 years later, the stuff that didn't make sense to you now, you're just second nature. Your brain just automatically does it. And you're set. You're set for the next 50 years of your life. You've been making 7 digits, maybe 8 digits without any trouble. So I would say if someone offers you a job on one of these specializations, I would go for it. The current CFO of USAA, he started in my department, and one of these came up as an opportunity, and he took it, and boy, radically changed his career. I told him, you got to take it. That's a great opportunity. So think complexity, and this is where complexity comes from. Complexity, you learn it, you become an expert in it, and then you make a fortune doing that. No one else can talk to you because what you're saying doesn't make sense to anybody else in the world. That's what you want. As I tell people, I know a whole lot about very little. That is what finance is all about. You specialize, and here's an area where you can really, really specialize. All right, and then the last one, I don't know if we'll finish this one out, is inflation. Students don't do a good job on the exam on inflation. So a lot of them just reword this. So we're talking about here, there's really only 2 types of bonds here. There's those that don't adjust for inflation and those that do adjust for inflation. In the US, those that adjust for inflation are really only offered by the US government. They're called TIPS. They're Treasury inflation protected securities. The way TIPS work is they pay a stated coupon, what you might think of as the real yield. And then once a year, the principal is adjusted for CPI, for inflation. So it should help you with inflation, should keep up with inflation. The stated yield can be really low and even negative. These bonds have had negative yields. So I don't know why people were buying them back then. They're back to positive yields now. What these bonds do is they should protect you from inflation. So you would have thought these bonds would have done great in 2022 when inflation took off, but they did horribly in 2022. So you would have been really disappointed if you put all your money in these beginning of 2022 and didn't look at your portfolio at the end of the year and say, man, I'm so glad about those that were protecting me. And you look at your portfolio and you were down. You wouldn't have been down as much as other places, so you might have been kind of happy that you're only down 5% or so. But you would have hoped that you'd been up 5 or 10%, and instead you were down. So they didn't help. Why didn't they help? You're getting paid inflation, but these bonds also have real yields. And in 2022, the real yield went from like negative 0.7 to positive 1. So that's part of your discount rates. So what you picked up with the inflation, you lost because of the discount rate. And so these bonds have not performed as well as we would have liked. One thing we love about them is they give us great insight into what the bond market thinks about inflation and interest rates going forward. So I have a YouTube video you can watch. It shows you how to bootstrap the yield curve. I highly recommend you learn how to do that. It's an incredibly great skill to have. If you don't even know what that means, go get that. I think I have the link in my notes, class notes. And you can actually make bets. The bond market will tell you what they think the 5-year treasury yield will be in 5 years from now. If you don't agree with that, you can make a trade and make a bet now. The bond market will tell you what they think inflation is going to be in 5 years. If you don't agree with that, you can make a bet and actually make money today. So you can buy a 10-year and short a 5-year, or you can buy a 5-year and short a 10-year. There's all these different trades. You can buy a 5-year tips and short a 5-year tips, or buy a 5-year 10-year nominal and short a 5-year tips. There's a bunch of trades you can do if you have an opinion, but the bond market is telling you what they think interest rates and inflation will be in the future. And that's a really wonderful thing with these bonds. So I was at an inflation conference many years ago when these first came out, and there's a Fed member speaking, and they were having trouble getting these bonds to sell because the market was leery about them. So they asked the Fed to buy tips just to prove to the bond market these were good investments. And the Fed was like, our job is to keep inflation under control. What is the market going to think if we buy a bond that does well when inflation takes off? That doesn't look good. The optics on that is terrible. So we're not buying tips. That's like goes against what we're supposed to be doing. But tips have done well, but they are a bizarre animal. So if you really want to get into the complexity of it, go into Google or whatever you use. I don't even know what I'm using here. You can ask, what is the duration for tips? And it didn't come up. So I'm going to show you how to calculate duration on regular bonds when we do bonds later. It's very, very simple. Tips are much more difficult to calculate duration for. They're a very unusual security. What is the duration of a tip? It doesn't work because that inflation adjustment. You can get the duration of the real yield, but that doesn't tell you what the duration of the inflation part is. So you could make your whole career just on doing tips. I don't know anybody that's what they do. I did meet the guy who wrote the tips chapter for Bozy, but he did a lot of other things besides just tips. But what tips give us is the actual real yield. So the real yield is you take the nominal yield, what the treasuries are actually paying, not minus inflation, but minus expected inflation. So if you want to go back to the 70s and see what the real yield is, you can't do that because we don't know what expected inflation was in the 70s. We only know what actual inflation was. But now we know what expected inflation is because we have the nominal yield, we have the tip yield, and the difference in that is what the market expects inflation to be going forward. So that's a really cool thing, actually quite helpful. These things have only been around for 20 years, so we don't have a lot of history. UK and Australia have tips that have been around a lot longer. I think the UK has been a very long time. What if you want an inflation-linked corporate bond? Well, in my property and casualty class, we talked about, well, what you might be able to do is buy a corporate bond, short a treasury, nominal treasury, and buy a tips. So buy the corporate, short the nominal, buy the tip. You could essentially create your own corporate inflation-linked bond. I don't know anyone has done that, but if any of y'all want to start your own firm and start inflation-linked corporates, that's the way I would do it. I don't know if there'd be a market for that out there, but it'd be kind of a cool thing to do. Be pretty interesting. Or you could just buy tips and put some credit default swaps on top of them. All right. That's bonds. There's my YouTube. I'm quite confident I put it in the notes. I strongly recommend you learn how to do that. It's really, really powerful. In fact, I'll tell you a story to be my last thing off the chart. So I was sitting in my office, minding my own business. The phone rings, I pick it up. It's the CEO of USAA, Bob Davis, and he's upset. He's in the room with a bunch of, he says he's in the room with a bunch of finance people. That wasn't true. He was in the room with a bunch of accountants. None of them knew how to bootstrap a yield. So he goes, Ron, can you show him how to do it? I knew how to do it because I'd taken the CFA exam, but if I didn't know how to do it, I would have lied and said I knew how to do it, but I knew how to do it. But that's how useful it is. It's really powerful. It's an incredibly simple technique and it's really powerful. And there's a lot of people who don't know how to do it. So, all right, I'll stop it there. On Thursday, we'll have our team question on duration and convexity. So be ready for that. All right, so you should be working on your exam one, question one. You should have a pretty good draft going. Looking at some of your answers, yeah, there has to be a lot more depth. So remember when you're doing duration, convexity, credit, we've got to define it. You got to give the subcategories and you got to talk about strategy. You got to have those three things in there. All right. Now we move to an easier one, which is stocks. But on stocks, where students lose a lot of points, is this introduction. So take a lot of notes. Make sure you want to put it in your own words. Understanding a stock. Last night in the Investment Society, we were talking about stocks. Some of the stuff that they were showing, I don't agree with. So I should probably have a debate with them before they put the presentation up. But they use the word equity and stocks. Are all stocks equity? Yeah. Is all equity stocks? No. What does equity mean? You just own something. So there's something called equity real estate. Is that a stock? No, you own a piece of real estate. My job when I retired from USA, I was VP of equities. It's a bad title. What should I have been? VP of stocks. But it doesn't sound as cool. So they said equities. But I don't buy real estate. I worked a lot with the real estate company, but I wasn't the real estate person. So stocks and equities are not, the stock are equities because it's ownership, but not all equities are stocks. So to give the introduction, understand what is a stock. When you buy a stock, what are you actually doing? And then how do we break up stocks into different risk categories? So bucks, beta, US versus non-US, capitalization and style. Those are the four categories you normally see. So we'll walk through those, but let's start off with what is a stock. So it represents a fractional ownership in a firm. When you buy a stock, you become an owner of the firm. You might be a 0.00001% owner. You only own 3 shares of Apple, but you are an owner. That gives you the right to vote. You can elect management. It gives you rights to do things as an owner. Bondholders don't have that. Bondholders don't get to elect management. They don't get to set strategy. All they can do is make sure the firm pays them back. It's a residual ownership. So the stockholders get whatever's left over after you pay the bondholders and employees and vendors and all those kind of things. So it's a residual ownership. You have unlimited upside, but what's the most you can lose? 100%. Now you might say, well, duh, that's obvious, but it isn't obvious. So we have something in the United States called limited liability. So that means once the firm goes out of business, the most you can lose 100%. That's not true with everyone. If you've heard of Lloyd's of London, you invest, and if they don't have enough money, they call you and say, we need more money. They lose money, you got to bail them out. You're required. Do you want that kind of investing where you have unlimited upside and unlimited downside? That's pretty dangerous. So in the US, we have limited liability. Some people think this is the secret to US success, that limited liability, telling people, hey, you're taking all this risk, but the worst you can lose is 100%. And people say, okay, I can have a 40,000% upside, but I can only use 100. I'm willing to take that risk. If you tell people, hey, if this firm goes under, you got to step in, pay off all the bondholders, pay off all the employees, all the vendors. Even if they run out of money, a lot of people say, no, I'm not going to take that risk. That's too risky. So it is an important concept in the United States. It does drive innovation and growth. Many people believe. There are some people who don't like limited liability, want that changed. You know, you can certainly have that debate. Some firms have done some really awful things. Certainly you can sue management. So management can be sued. You can sue the board, but you can't sue stockholders when a firm goes under. I don't think anyone's ever tried this. So But yeah, you can definitely sue the board and you can sue management, but stockholders, they're off the hook once the firm goes under. Here's the real key. What is a stock? It's so simple. The return on the stock is the dividend yield plus earnings growth. How much simpler could you get? Current dividend yield, which is dividend yield is what the dividend they paid as a percentage of the stock price. So if the stock's $100 and they pay a $2 dividend, that's a 2% dividend yield. And then expected earnings growth. Stocks are so easy. It's all about growth. How fast are earnings going to grow? That's what you're buying. Now, there is something called repricing. We're going to ignore that. But repricing means sometimes stocks prices go up too high or go too low. You have what's repricing. So you have these adjustments. You could say repricing is just noise. Or the stock market gets ahead of growth or something. So it's just a little bit of noise. We're going to ignore that because it's impossible to measure or it's really speculative. But so if this is the case, is that how stock markets actually move? So I've been hearing this my whole career. So I said, well, let me go see. What have stocks actually returned? Have they actually returned dividend yield plus earnings growth? And so I graphed it out. I love this graph. How did I go back to 1871? If you see 1871, where did I get the data? So this has to come from, if you do, I didn't even put him out there. Oh, I've already forgotten his name. No, not that one. I forgot his name. How did I forget his name? Oh my word. It's Schiller. Let me try Schiller data. I forgot his first name. Robert Schiller. How could I forget? Robert Schiller, he's a Nobel Prize winner. He wrote a book. I don't have his book on my reading list. I didn't finish it. So he's a little bit dry as a writer, but when you see 1871, it's Robert Schiller's data. And you can get his data for free off of this website. It's an Excel spreadsheet where you get stock returns back to 1871 on a monthly basis. And it is the S&P 500, even though that hasn't existed that long. So how did he get, what was in the U.S. stock market in 1871? Maybe some banks, some railroads. I don't know what else. There's not a whole lot. There weren't any Walmarts. There probably weren't any national stores. So I'm not even sure what that was at that time. But Robert Shiller, have y'all seen him before? They say he's an economist, but he's known more in finance. So he has his data, which is on here somewhere for free. Well, there is the online data. So yeah, you can just click on it and suddenly his data comes up. I don't know which one I want. I'll try that one. Yeah, that's not the one. So I'll do the other one. Yeah, this is the famous one. This is called the Case-Shiller Index. Very, very famous index. So what this shows you in the blue is the stock market. When the blue line is high, stocks are overvalued. When it's low, they're cheap. The red line is bonds. When the red line is low, treasuries are expensive. When the red line is high, treasuries are cheap. So you can see they go in opposite direction. So high blue line, stocks are expensive. Low red line, bonds are expensive. So you can see in 2020, bonds were the most expensive they've ever been. Why? Because the 10-year treasury is paying 0.5%. You're not going to make a high return on treasuries if they're yielding 0.5%. So that's the most expensive treasuries ever been. I was shorting treasuries in 2020 because they just seem so ridiculously expensive to me. It's like, why wouldn't I short? I mean, are interest rates going to stay at 0.5% forever? They're much more likely to rise. What about stocks in 2000 when we had the dot-com fiasco? That's the most expensive stocks have ever been. And what did they do after that? They got really cheap, really fast. And then what happened in 2020? I don't know what year that is, but I can't tell exactly what year that is. But right here, 2022, right before the the inflation scare and stocks sold off. That was the most expensive stocks have been other than 2000, even more expensive than the roaring 20s. Where are we today? People like to point out stocks are more expensive today than they were before the 1920s. So you see why some people are predicting a major stock sell-off. That's based on his chart. So what is he doing? He's looking at the price of the markets versus earnings, but he doesn't use today's earnings. He uses 10 years worth of earnings adjusted for inflation. So you can compare them over time. Inflation goes up and down. He has that taken out. So essentially he's saying, how much are we paying for a dollar of earnings today versus in the past? If we're paying more for a dollar of earnings today, we must think earnings are going to grow faster today than they have in the past. And yet most people think it's the exact opposite. Earnings can grow more slowly. So there are people who look at that and say, wow, the stock market looks really, really expensive. Bonds look pretty normal right now. Or they did, rates have come back down, but bonds are back to, I'm actually buying bonds again. I started buying bonds when interest rates, especially when the 10 years started approaching 5%. Yeah, I'm buying bonds. How good is this for investment strategy? It doesn't work too well because if you try to time it and you don't know where do you short stocks? Right here, right here, right here, right here. No, you do it right there. But do you know this is where you are when you're right there? You don't. It could keep going. So it's not the easiest. I was actually arguing for us to short stocks from that point. And the CEO says, okay, I hear what you're saying, Ron, we'll do it when the time comes. And I was like, I think the time's come, but I couldn't convince him. That's the first time in my career I ever talked about a bubble, mainly because NASDAQ was just so ridiculously expensive. Right here, yeah, people are getting nervous. Stocks are pretty expensive. So going back to 1871, I'm using his data, trusting his data. And what I did, and what I love about this chart is the blue line is the actual S&P 500. So if you started with about $9 back then, you'd have over $1,000, $5,000 today. So the blue line is the actual S&P. The red line is each decade's dividend yield plus earnings growth. So if you took $1 and grew it by the dividend yield plus the earnings growth, that's what the red line is. And if you look at this red line, it follows pretty closely, doesn't it? There's the roaring 20s, and what did it do? We got above the line, corrected. And it came along again, and in the 60s, it followed pretty closely. Then you had the dot-com bust, then you had 2008. What did it do after 2008? Came back down to the line. Where are we today? We're in another one of these extended periods. The stock's looking really expensive. And there's a huge difference between those two lines, like 50, 60% difference. So what's going on? So there's a couple things. Number one, stocks could be ridiculously overpriced in the United States. That's possible. The second thing could be is stock repurchases. So dividend yields used to be more important than stock repurchases. But today, companies are buying more stock back than they are issuing dividends. So I need to put that in. I actually adjusted this chart for that. So that doesn't help you, but that could be one answer. But at least I tested to see if you added stock repurchases, that did raise the line up a little bit on the red, but not enough. The one thing I think is really going on here is risk. Well, risk and fees, all right? On risk, stocks are much less risky today than they were a long time ago because we have so much information at our fingertips. So what happens to the price of something when we reduce the discount rate? Its price goes up. So a lot of this adjustment the last 30 years could be that real stocks are just a lot less risky. So we just have, and that's a one-time adjustment. So if that's the case, stocks could be okay today, but going forward, the red and blue lines will just go parallel. You shouldn't see that separation. So that's a one-time adjustment for risk. The second thing is expensive. In the 70s, you won't believe this, but it's absolutely true. In the 70s, if you did a stock trade, it would cost you $50. That's how much commissions were in the 70s. Not in today's dollars, in 1970 dollars. In today's dollars, it'd be several $100s. Would you do stock trades if it cost you $300 to do a trade? Wouldn't make any sense. How much is our commissions today? Zero. Right? Charles Schwab's, Robinhood, thanks to Robinhood, there's zero now. We went from $50 a trade to zero. So the expense, and you can buy an index fund that charges you almost nothing. Or back in the 70s, they were charging you 1% or more. So the expense part wasn't in my equation anywhere. So if you take the expenses out, it makes sense stocks would be a lot higher today because we get that one-time benefit. Jack Bogle says that benefit well, this is an economist article. It could be trillions of dollars to investors. Getting expenses down on investing, index funds, those kind of things is worth a lot of money to investors. That again is a one-time adjustment. So going forward, these two should just go parallel. Should we be concerned about that? Yeah, we should. I don't think you can make an argument that stocks are cheap. I don't think anyone can make that argument. Could you rationalize that they're not that expensive? Yeah, you probably could. I think they're expensive. I don't think they're radically expensive. Part of my equation, and one thing I wish I could do, is the breadth of the stock market. Y'all know what it means by market breadth? So in the 2000s, we had very, very narrow market breadth. Why? Because only a few .com companies are driving everything up. Most stocks are just going sideways. And so the market looked like it was going up, but really what was going on was only a few companies are going up. What's happened in the last 3 years? We had the magnificent what? Magnificent Seven. They're the ones driving markets up. So the market itself may not be that expensive if you take the Magnificent Seven out. The difference between today and 2000 is in 2000, those .com companies that were driving everything, they had very little earnings. Today, the Magnificent Seven have a lot of earnings. They're very profitable. So their stocks are going up for good reasons. But if you took them out, the stock market wouldn't look that expensive. But I think it is consistent that stocks over the long run do give it a dividend yield plus earnings growth, but there are these one-time adjustments for risk and expenses like two lines can get off. But I think going forward, your best estimate for the stock market is dividend yield plus earnings growth, maybe an adjustment for stock buybacks. So if the dividend yield today is 1.5%, stock buybacks might add another 1.5%, earnings growth might be 6%. Now you might expect stocks to make 9% going forward. So you still have that as your expectation. Questions on that? I love this chart. It's a really powerful chart. So how do you get expected earnings? Dividend yield is really easy to get. I'll show you how to get well, I don't know if I can. We'll try. Yahoo Finance is really irritating right now, but we'll try. Oh, I'm going to do, excuse me. I'm going to do the SPY. Anybody know what SPY is? The spider or the S&P 500. So the dividend yield on the spider is the dividend yield for the stock market. And right now it's 1.21%. Historically, that number's averaged 4%. So if you can get dividend yield plus earnings growth and the dividend yield is 1.2%, and it used to be 4%, there's 2.8% of return you're not going to get. But what do we add to that number? To stock buybacks. So dividend yields are much lower, but stock buybacks are much higher. So historically, that number has been around 4%. You add about 1.5% to that, we're kind of going from 4% to about 3%. But that's the dividend yield. You'll use this on papers 3 and 4, paper 3 especially. All right, so this you got to flesh out on your answer for the exam. So it's a logical argument. So stocks give you dividend yields plus earnings growth. Where does earnings growth come from? Where earnings growth is closely tied to economic growth. So stock earnings can't grow 8%, the economy is growing 6%. It's not possible because then corporations would take over the economy. We wouldn't have any consumers, we wouldn't have any government. So one part of the economy can't grow radically faster than the others without those others shrinking. So corporate earnings have to grow in line with the economy. Well, let's ask that question. Is that true? Oh no, I got the wrong chart. Oh, I got the wrong chart in there. Oh no. Let me see if it's in the class notes. So I'll bring it up in the class notes. Sorry about that. I copied and pasted the wrong thing. There it is. Wow. All right. So do corporate earnings growth align with economic growth. So I've got a few lines up here. The red line is actual growth in corporate earnings. The top green line, that's actually economic growth. The next growth is just 5%, just to give you a baseline. And then the blue line is, I'm using what Dr. Damodaran uses. He says corporate earnings growth should be closely tied to the 10-year treasury yield. I don't necessarily agree with that, but that's what he says. All right, so I'll put that number in there as well. It actually does a pretty decent job. So what's the first thing you notice with this number? I'm going to expand it here a little bit. One thing you notice is our economy grows faster than corporate earnings. You notice that pretty consistently. It kind of got close a couple of years ago. Which is more volatile, the economy or corporate earnings? Corporate earnings by far. Can you notice 2008 in there? Why did earnings fall so much in 2008? We blame that on the accountants, right? We have an accountant here. What did accountants do in 2008 to kill earnings? Fair market accounting. People were writing bonds to market. In the USA, we had to write bonds off like, I don't know, $5-6 billion worth of bonds because they had to get marked to market. That wasn't true in previous years, or it would have been that volatile, but that's fair market accounting. What happened in 2009? Those bonds came back and the earnings came back. So that was just noise. So you can almost ignore that. But corporate earnings, they almost had the same growth every economy for like 13 minutes, one quarter, but corporate earnings don't grow as fast. I think they actually do grow as fast, but this is the S&P 500. So there's other companies besides the S&P 500. There's a lot of small companies. Small companies grow a lot faster than big companies. So if I brought all companies in, I don't have that data, but if I brought all companies in, it would probably be much closer. But small companies, yeah, they go out of business, but that's minus 100%. But the ones that make it are up, 5,000, 500,000%. So you get a lot more growth from small companies. They do drive our economies a lot more. New companies come in. That's not in the S&P 500. So there's a lot of growth. There's private companies. There's a lot of growth not in that red line, but you can certainly see there's some consistency there. If you look overall, corporate earnings growth is 6.1%. Our economy has grown 6.4%. Pretty close. You see why you can't assume stock can grow 8%, the economy's growing at 6%. There's no historical justification for that, unless you're sitting, obviously, if you're sitting right here, you can obviously assume really, really high earnings growth because it's going to recover, but not so much when you're in normal periods. The Damodaran with the treasury yield, that does seem to be a pretty good point of it revolving around that. So a corporate 10-year treasury is yielding 4%. That's what he says your growth rate would be. That seems awfully low to me, but that's what he would argue going forward that would be. Be real careful on this GDP. This is nominal GDP, not real GDP. So this includes inflation. Why? Because corporate earnings give you inflation. Corporations do somewhat protect you. Stocks, when you buy stocks, you get some protection from inflation because their earnings will go up into inflation. So we're including inflation here. This is not, you might say, how GDP is not 6.4%, but nominal GDP is. Real GDP is like 2.5 to 3%, but nominal GDP, yeah, 6.4%. Questions on that? So stocks give you dividend yields plus earnings growth. Earnings growth should be closely tied to economic growth in all countries. All right, well, what's the next obvious question? Where does economic growth come from? See how this is so logical? Have y'all taken logic classes? I encourage all finance majors to take a logic class. Do you have to take a philosophy class? You have to take ethics, don't you? Do you have any electives? So if you have an elective you haven't figured out, I would take a logic class because there's a lot of logic. If you're an accounting major, don't mess with logic. It's not going to help you. But if you're a finance major, logic is a big part of what we do. It's theories, premises, and conclusions. So there's a lot of logic to this. What is stocks giving? Dividend yields plus earnings growth. Earnings growth for corporations is closely tied to economic growth. Where does economic growth come from? Well, anybody want to guess? I'm going to say there's 3 pieces. If you read the notes, anybody remember? Labor growth, yeah. One starts with a P, one starts with an I. It's the same I in DC cuts I. Huh?
Immigration.
Well, immigration is part of the P, but what's the P?
Productivity.
Productivity, the single most important thing out there. And then what's the I? The same I as DC cuts I.
Inflation.
Inflation. Those are the three pieces. Inflation, you don't really want that piece. So here's the components of GDP over time. You can see how big inflation got in the 70s. Labor growth in the 2000 to 2010, and the first time in US history, we had fewer workers at the end of the decade than we did at the beginning. It's the first time in history. Why? Because we had way too many workers at the end of the 90s, especially in banking and construction, and we had to let some of them go. That's labor growth. And then the most important one is productivity. I'm going to show you some articles on how important productivity is, maybe next class. The economists, every time they talk about a country and their struggles, they talk about growth. And every time they talk about growth, it's all about productivity. You're not going to grow a country by increasing its inflation. Yeah, its economy will grow faster. You have a lot of inflation, but that's not the kind of inflation, and that's not the kind of growth you want. That's bad growth. You want productivity. Productivity is the key to your wealth, to a nation's wealth, to a company's wealth, to your personal wealth. It's productivity. What is productivity? It's very, very simple. I can write it out to you for you, so it's real easy. I don't know if do your finance classes cover productivity? I mean, your economics classes. Anybody know the definition of productivity? So you got real GDP growth. Let's say that was 3.5%. You have growth in labor hours. Let's say that was 2.2%. What is productivity? So the economy grew at 3.5%. We had to add 2.2% more workers to get it. How much is our productivity? It really is as simple as you think it is. Any guesses? Don't go that way. 1.3%. Our economy grew 3.5%, 2.2% because we added more workers. 1.3% came from us being more productive. Your wealth comes from that 1.3%. Single most important number. Governments talk about it. I think I mentioned it, but I mentioned it again. And I'll try to find this if y'all want to, because it's a really good article. But President Obama, his very last month in office, wrote an article for The Economist. And he talked about his biggest regrets, and productivity is it, because productivity has been really weak in the United States and in Europe. And he said, productivity, I wish we could have had stronger productivity. Why? Because that's the wealth of nations. That's where it comes from. His solutions, I thought were interesting. He talked about the obvious thing, which is education and training. I might have a disagreement with him on how to fix the educational system, but I agree it is, you got to get your workers, got to be more productive. And how do you make someone more? What are y'all doing right now to become more productive? You're attending classes. You hope that makes you more productive, don't you? You're not getting a finance degree so you can, flip hamburgers at McDonald's. I'm hoping. Probably not. You're hoping you can have more value than that. Not that that's a bad job, but they'll pay you a lot more in finance because you have skills, you have training that's a lot harder for other people to get. So that's productivity. You can look at it over time. Just type productivity in Fred. And there it is over time. See how volatile it is. You can see how low it gets during recessions. That's productivity over time. You can do all type of analysis here. What I like to do with productivity is look at it like 5-year averages. So you can see how it's changing over time. So y'all got that trick, right? You just productivity and Fred. Fred is the St. Louis Fed. You get all these wonderful charts that you can use. So let's look at it on a 5-year average or even 5-year median. 1, 2, 3, 4. So there's 5 times 4, so we need 20 of them. I don't know how many it is because it's not giving me a number. I'll try average and then we'll try median as well. I'm not sure how big of a difference that's going to make. All right, so there's productivity. If you look at that over time, over decades, sorry, I edit this a little bit. So you can see in the 50s, we're averaging well above 2.5%. Then we dropped down a bunch in the 80s. We recovered some. Here's the .com and just internet and everything coming along. And then you can see how weak it got in the last few years. It's really much lower level than we've seen historically, which means going forward, our economy is going to grow more slowly and corporate earnings is going to grow more slowly. What could save productivity in the United States?
Yeah.
AI, yeah, artificial intelligence is going to save it. What's that going to do to labor growth? AI is going to do this wonderful productivity. What's it going to do to labor growth? Might decrease it. Who knows? It might. Who knows? It might increase it in some areas and decrease it in other areas. What else could you do for productivity? The educational system. There's two really unproductive sectors of the U.S. economy, which may be why this is dragging down. You want to guess what those are? Two most unproductive. So one is healthcare. Our healthcare system is incredibly unproductive, mainly because it's people focused. You got doctors and you got a lot of one-on-one. Could AI solve that? Do y'all know that AI already reads X-rays better than doctors do? Has a better success rate, it's more accurate. So AI is coming into medicine. It's not quite replacing it. What's the second one? You're sitting on the second one. Education, woefully unproductive, terribly unproductive. How do you fix education? Do y'all think we'll be sitting in a classroom 20 years from now? Do you think your professor 20 years from now will be an AI robot? It's possible, right? I'm encouraging my secure analysis class to use ChatGPT for research, not the copy and paste, but for research. And it's amazing. We were doing some value chain management. It was pretty impressive. The fortified forces was pretty impressive. I thought the SWOT analysis was a little bit too elementary, but it depends. You at least get some good ideas. It's far better than the other resources we have online to use from the library. Not the same thing bad about the library, but just those sources they provide us. ChatGPT actually does a lot better writing. So that's what we're after. How in the US can you improve productivity? There's the 2% line. You can see in the US, 2% productivity is a very difficult place for us to get. So if you're going to argue for higher than 2% productivity, you have to really believe in AI. There are other solutions out there, autonomous vehicles. There's other things we're talking about that could have a pretty major, energy side. We might find some new discovery in energy or in batteries or whatever that might have a huge impact on productivity. But I would say people talking about AI, wow, we got all these new productivity things, but think back to the 1900s. Do you think we're going to discover something that's as productivity enhancing as electricity? You think we're going to find something that great? Our airplanes, our cars. What would be your productivity today if we didn't have air conditioning in Texas? Would you work in Texas? So that increases almost my bike this morning. It was so muggy outside. You just don't have any energy. You want to do anything. So some people say, wow, we got all this new productivity. It's like, yeah, but compared to what we had in the past, you can't even compare. I always like to say, take someone living in 1800 and try to tell them what we're doing today. Do you think you could explain, if you go back in the time machine, could you explain to them what we're doing today? Could you explain the internet and cell phones? And so that's one thing you notice. Could someone in 1800 go back in time and explain to someone in 1600 what we were doing? Piece of cake, wouldn't it? Could someone in 1800 explain something and people in 1400, would they be shocked? What? You're doing what? I can't believe that. It's pretty easy. So there's been a compression in productivity where the stuff we say today, in fact, if I was trying to say, could I explain stuff today to my high school, me as a high school graduate, I'd have a tough time explaining some of the stuff we're doing today.
So is productivity just like innovations?
Innovation is a big part of it. It's anything that a worker produces more. Are now computers and robotics. So we're getting more compressed. Do you think there's stuff we're gonna be doing in 2040 that you would have a tough time explaining to someone in 2020? Who knows? But it's getting more compressed. But there's stuff to do in 1980. I could probably explain to people in 1960 versus now. To me, the most amazing thing to me when I first started looking at it was GPS, because I bet none of you have ever used a map. You should have seen us driving with maps. We had these things out in the seat. We're trying to look, we're trying to drive, but now you have a computer telling you to turn right at the next corner. That to me is just amazing. You're so used to it, you don't even think about it. But it's just amazing. What I just did right here, if I'd done this in class in 1980, how long would it have taken me? Where would I get the data? I had to go look it up in a book. Then what would I have done with it? I'd have to take a big piece of white paper, draw a graph, and I would have to put each point on the graph and then connect it by hand. You know, give me 5 weeks, I can probably get that done. There's probably, how long did that take me? You know, 2 minutes maybe, you know, so productivity is really high, but why aren't we seeing it in the numbers? Why isn't AI, why isn't the internet, why isn't everything we're doing, why aren't we seeing it in these productivity numbers? Some people believe the numbers calculated incorrectly. There's part of our economy that's not going in these numbers, and that is true. I think it was Ethiopia or Nigeria, I can't remember which. Is a country in Africa that they recalculated their GDP because there's a big part of the economy that wasn't in the number, and suddenly they went from a smaller country to the biggest country in Africa. So it's possible, just the calculations are wrong. We know in China right now, we don't trust their GDP numbers because they just don't seem to be correct. It's hard to, so there is some just subjective guessing going on these numbers. The economists are really smart, but it's possible there's something major missing from these numbers, that our productivity could be much, much, much higher. But if you want raises, and this is the reason why wage inflation is higher than CPI. Because if productivity is 2%, you can pay your workers more than inflation and still make money. So productivity is 2%, the company can keep 1% of that and pay their workers an extra 1%, and they're both better off. So productivity is really, really key. If you want to know who are the wealthiest countries in the world, go look at their productivity. Productivity is key to these numbers. So it's one of the most important numbers. So if you look at these numbers, productivity has ranged in the 2 to 3% range. Here's where President Obama was talking about. Why is productivity just so low during that decade? Kind of surprising given the internet and everything going on. Big drop here, but then we lost labor growth. But look at labor growth. So labor growth grew a bunch in the 60s and 70s. I think we mentioned that before. Where's labor growth coming from there? So women joined the workforce for 2 decades. So you've got that going on. But labor growth the last few years, it's been okay, but it hasn't been the 2%. We're talking 1%. And what could really devastate labor growth? Well, all these baby boomers finally retiring could have that impact. You're hoping they retire because you want their jobs, but that's also going to reduce labor growth. What's going on in Japan? The country's shrinking. They don't have enough workers. They're using more robotics. Japan is like the king of robotics. It's kind of sad to see elderly people and the only interaction they have is with a robot. Even their pet dogs are robotic dogs because they just don't have enough resources to take care of this really huge aging population in Japan, and not enough people. And a lot of Japanese youth are like, I'm not getting married, I'm not having kids. And it's just, you know, it's a population issue. How do you offset that? You got to offset that with productivity. And that's what Japan's doing. They're offsetting human labor with with a lot of robotics and AI and those sort of things. Inflation is whatever it is, but the Fed's targeting 2%, so maybe you would use 2% as your inflation number, who knows? So going forward, what you have, this last column is the medians, but that's history. You're looking going forward, how fast can our economy grow? So productivity, 2% is probably about what you're gonna think. If you say 3%, you're somewhat off the charts, aren't you? We've only had one decade with 3% productivity, and that was a decade of all the servicemen and women coming back from war and the GI Bill, and people going to college for the first time and all this kind of thing, even manufacturing. So 3%, unless you have a really big belief in AI and what it's going to do, 3%. So I think it's about how you can get, I don't know if you can get much higher than 1% on labor growth. That's gonna be pretty tough. So if you look at these bottom two, that's real GDP. So let's look at some real GDP. So here's our GDP. Let me do the same thing again. It only goes back to 1948. So it's it's post Great Depression. So what do you notice there? What's the trend line there? 4%, 3%. What about the last few years? 2%. Our economy is growing more slowly and more slowly and more slowly. Why? Labor growth is approaching zero because all the baby boomers, and then productivity is giving that productivity is really low this last decade, so giving that 1 to 2%. It's a scary number. It's a scary number for an economy. It's a scary number for a stock investor because you got to get that number higher if stocks are going to be a good investment. Questions on this chart? On paper 3, you can use these charts in your paper and you'll see how you can set them up. So what do you think earnings growth is going to be going forward? 5% is a pretty decent number. 2% productivity, 1% labor growth, 2% inflation. It gives you about 5%. I think that's a pretty decent number. What if you find someone who thinks the economy is going to grow at 9%? I think it's kind of crazy. I remember President Trump, I think he said 5%, but we weren't sure if he was talking nominal or real. I don't think you're going to get a real GDP growth of 5% anytime soon. I just don't think it's possible. This economy. Another study, Robert Arnott, one of my favorite writers, he says the key to productivity is the age group of the populace. So don't answer this too quickly. Think about it. Who's more productive, a 50-year-old or a 20-year-old? Who's more productive? 50-year-old. Why? More experience, more training. That's not the key to the growth in the economy. The key is the change in productivity. Whose productivity is improving the fastest? The 20-year-old. So what does that imply? Countries with a bunch of 20 and 30-year-olds are going to see a lot more productivity than countries like Japan, the United States, and China with a bunch of older people. So countries like India, there are some countries in Latin America with younger populations. That's where you're going to see more productivity because they have more young people getting skills, getting trained. So that's really the key. Robert Arnott, it's an old article. I have it if you're interested in it. It's kind of old. He came by USA and spoke to us on this article where he lines up all the countries based on the age group, the age of their population, and just shows you where most economic growth is going to be. Japan was always at the bottom, the worst. When people think of China as, this young, but China has an aging population problem too. Why? Because of the one-child policies. So they have a problem of not having enough kids coming up through the ranks. So Africa has a younger population, Latin America has younger relative, everybody is cutting back on having babies, so we'll talk about that. Fertility rates are down everywhere, but they're down much more in the West and in China and in other places. So India is a great place. Africa's got several countries with really good populations. And Latin America has some areas that are doing pretty well. But a lot of the world, especially the big part of the economies, a big part of the stock markets are just really, really low population growth. If you have low population growth, you're going to have low labor growth. I mean, unless we're going to go back to child labor, you're going to have a tough time finding other workers to come in. And a lot of 70-year-olds don't want to work anymore. It's going to get tough. So we've got some numbers. They're not as scary as Japan. Japan is just like the worst case scenario. And they're really struggling with large deficits, massive pension plans, and a young workforce that just doesn't want to have kids. It's a tough scenario for them. So historically, stocks have given you about a 4% dividend yield. And earnings growth has been about 6%. So historically, stocks have given you about a 10% return. And I remember Dave Ramsey was talking about getting 12% out of stocks, and he got some really bad press on that. Like, how are you gonna get 12% return from stocks? It's just, there's no way to argue that. So, but Ramsey's not an investor, he's a budgeter, so he doesn't really know what he's talking about in that area. So he got some pretty bad beat up on that. Anyone tell you they think stocks are gonna make 12%? It's like, yeah, show me where that's gonna come from. So economic growth, I think it's about 5% on a nominal basis. Dividend yields are pretty low right now, 1.2%. You lock in 1.5 for stock buybacks. Stocks are going to make, I always use it somewhere in that 6 to 9% range is what you're talking about. I mean, does that excite you to buy stocks to make 6% when you can buy treasuries at 4%? Doesn't sound as great, but that's the low end. 9% sounds pretty good, but it's not the 12% some people are touting. If you're going to have a different number, you better come up with some argument for why it'd be higher. So productivity, where does that come from? You mentioned innovation. That's really key. So you might ask the question, which countries are the most innovative? The US still leads that by far. China is definitely catching up. It's really amazing. Some of the companies China is producing, especially electronic vehicles, Tencent, Alibaba, there's some pretty impressive firms in China, which is pretty unique. They used not to produce those type of high-tech leading firms. China has big advantages in AI. So we'll see, but China also has some political issues that are pretty scary. So what does that do to productivity? So, you're looking at each country. The US still has a huge advantage on innovation. We still have some of the best schools. We still have Silicon Valley. There's a lot going on. You have Austin and Boston. You have places where there's a lot of innovation going on. Education is really critical. Where's the best educational system in the world? Who's always at the top? Yeah, you got the Scandinavian countries. You got China. You got Singapore. But even that's a little tricky. Yeah, Singapore is up there high, but then their kids are so burned out when they finish high school, they go to college for a vacation. So it's you gotta ask the long-term effect of that. Same thing with China. China government's been like telling their parents, you can't have your kids coming home from school and going to a tutor for the next 5 hours. That you just can't do that. So they're actually made some of these tutoring services illegal because the kids are just so pressured. But in the US, how's our educational system? How was your educational system? My 6th grade, I went through 6th grade, I learned 0. My 6th grade was so horrible. It was a terrible experience. I had some great teachers, I had some horrible teachers. But, we can talk about that. One of my former students, he's out there, he's leading the education reform in the US. The teachers unions hate him. I've told him you better check your card before you get in because they hate his guts quite intensely. But he's talking about reform, which is what we got to talk about. I volunteered about 15 years in inner city school here in San Antonio. I was shocked at how bad the education was in the high school and impressed with how good it was in the middle school. So the middle school kids were coming out with pretty good education, and then went to high school and they had 4 years of nothing. It was terrible. So there's a lot of disparity between our schools. I won't mention which country, but I have students here, UTSA from a Latin American country, and 100% of them went to private schools. Because they say the public schools in that country were just so bad. You could probably guess what those are. So that's key. We've got to get education better to get productivity better. Immigration is extremely important. I just read a book I highly recommend on immigration. And he makes the case for how much US economic growth depends on immigrants, not just high skill, but all levels. And he can go back with some pretty impressive numbers, especially most of the jobs being created in the US are from immigrant created companies. Immigration is really important. How good is the US political system doing on solving immigration? Not working very well, is it? So that's a big issue. Government regulations, we'll talk about ease of doing business here a little bit, but government regulation, how easy is it to start a business and run a business? And then there's cultural issues. Japan's really interesting because Japan historically has had firms that were not really focused on the stockholder. And they had a lot of these kind of cross holdings. So you looked at a bank and their big holding was another company. And so, the stock market was like intertwined. And Japan is starting to make a change on that. And you're starting to see the Japanese stock market reacting very favorably to that, where managers, CEOs of Japanese countries are starting to put, especially people from the US on their boards to have kind of that thought process, put the stockholders issues up there first, make sure you have good returns. And it's starting to take off. So that can have a huge impact on a country. But those are the kind of things you're looking for in a country. You're trying to find a country that has a good innovation system, good education. It has good immigration to get workers in that you need. And the government is somewhat conducive. All those things have to line up. So we'll get back to that when we talk about the non-US countries. I mean, the other countries outside the US, we'll get into those kind of details. All right, let's talk about the first ones. So we've got bucks. What's the B of bucks? Beta. So what does beta mean? We'll talk about that. What's the U of bucks?
It's not US.
US versus non-US. Here it matters on stocks. We'll talk about that. I showed last night in Investment Society. You remember the US stock market, the standard deviation daily is about 1% or 1.2. If you look at developed markets outside of the US, the daily standard deviation is only 1%. Why is that? Well, because currencies actually reduce the risk of international stocks because it provides diversification. What about the C?
Capitalization.
Capitalization, and then the S? Style. All right. So let's start with beta. So beta is, there's two issues on beta, and this is extremely important in the second question. First, beta, when we talk about your beta risk, it's just, do you want to be in the stock market at all? So beta risk is how much do I want to be in the stock market? When we talk about beta, it's how sensitive your portfolio is to the economy. So if you think the economy is going to take off and do really well, you want to be exposed to the stock market. If you think we're going in a recession, you want to reduce your stock portfolio. So that's one way beta is used. But more specifically, beta is which industries or sectors do you want to be in? There are high beta sectors and there are low beta sectors. Now you had beta in 2013, so hopefully you remember it. Let's try it. So is Walmart a high beta stock or a low beta stock? Low beta. Why is that? Yeah, discount store, groceries, staples. Tesla is a what? High beta, durable good. McDonald's. You think that's low? What about versus Walmart? Who's lower, Walmart or McDonald's? Walmart. So McDonald's is kind of a 1. Why? Because if you have a recession, people may not eat out as much, but they'll probably cut back on Olive Garden and eat more at McDonald's. But have y'all eaten McDonald's in a while? I was shocked. Last time I went, they had a kiosk and there was no one to help me with the kiosk. All the workers just ignored me. So they're cutting back their costs, but the cost of a hamburger there, I mean, it's like $20 to eat at McDonald's. It's ridiculous. So it's getting more expensive, but it is lower. I would probably put a McDonald's out of beta, like right in line with the market. So we have high beta stocks and low beta stocks. Another word for that are cyclical stocks and defensive stocks. Cyclical stocks have high betas above 1. So the market has a beta of 1. That's just by definition. So beta is saying kind of proportionately how much more risk do you have relative to the economy. So beta 1.5, you have 50% more exposure to economy than a firm that's average with a beta of 1. And defensive stocks have low betas like grocery stores, like utilities, low betas. Why? Because people are going to buy that stuff even in a recession. What kind of stocks are high beta? Well, obviously retail, like a higher end Nordstrom's, is going to be higher beta. Durable goods, cars, heavy equipment, planes. Commodities are almost always, but not always, but almost always are high beta. Gold may not be in that category because gold is a kind of a precious metal, kind of a little different. But travel and leisure. When's the last time you heard someone say, hey, I'm really worried about this economy. I might lose my job. I think I'm going to go on a vacation. Probably not going to happen. Now, the CEO of the local theater here, I forget the name of it. Regal, I can't remember which one it was. Who was it? Santigos. Yeah, I don't remember what he said, but we were saying, well, obviously movie theaters has a high beta. And he said, you know what? Not really. Because in a recession, people don't travel, but they want to do something, so they'll go to the movies. So it doesn't cut back as you, it's higher than 1, but maybe not as high as a cruise line. Say, okay, I can buy that, but have you been to movies like this? What's a movie ticket now? It's like $8 or something? $10, $12? That's crazy. There's not a movie worth seeing that you can't wait for Netflix. It's like, and in consumer discretionary, which some of those are discretionary, those things that people cut back on during a recession. It's pretty obvious. You just tie it to the economy. What are those things people cut back on a recession? Those are going to be high beta. Defensive stocks, department stores, discount stores, Walmart, Costco, Family Dollar doesn't exist anymore. I should take them off. Gasoline tends to be lower beta. Gasoline purchases do come down in recession. So I'm not saying all defensive stocks see their revenues flat, because if people are losing their jobs and not driving as much, but gasoline is not as sensitive as other things. People will tend to buy gasoline before they'll go on a vacation. Food is definitely low beta. Consumer staples by definition. Utilities, telecom doesn't really exist anymore. And they're not necessarily so low beta. So the S&P, they created a new industry or sector called communication services, and they put telecoms in there. I'm not so sure. Telecoms today they're kind of all over the board. They're actually in production of films and other things, so they're kind of a little bit more difficult, but they have historically been lower. Healthcare is generally lower beta, although you can't always be sure on healthcare that that's always the case. Technology, we're not really sure of. Technology is kind of all over the place. Some people are starting to say that your Apple phone is more important than maybe not food, but for some people it's more important than other things you might call staples. But some people are saying that technology has become so entwined into our lives that it may not be fast to be given up in a recession because we're just so dependent on it now. But we'll talk more about those. So those are the categories: cyclical and defensive. So beta is the measure of how sensitive something is to the economy. That's what beta is talking about. Specific to stocks, we're asking what sectors are you in. You have cyclical, high beta companies, sectors. You have defensive, low beta. So the only thing is strategy, and you know the strategy. If you're expecting a recession, what would you do? High beta stocks or low beta stocks? Low beta. Pretty straightforward. If you're expecting a recession, you want to increase your stock allocation or reduce it? Reduce it. Why? Because stocks are all about growth. Growth comes down in a recession. So it's really straightforward. Not difficult at all. In fact, for all of these bucks, well, for B, C, and S, or beta, capitalization, and style, they're real simply very easy to tie to the economy. You don't have to worry about interest rates or inflation. Those other things, all about the economy. All right. Okay, we'll talk these. I have this file. We'll talk a little more. Just my general sense, when I hear a stock, what am I thinking on beta? And I'm giving my list. Not everybody would agree with this, but my list of where beta ranges could be. The lowest I'll go is usually grocery stores around 0.4, 0.5. I don't generally go above 3 on beta, so I'm usually between 0.4 and 3. Could you argue like Ford manufacturing cars and has a lot of debt, have a high beta. Yeah, but Ford is also, where does Ford make most of their money? It's Ford Motor Credit. It's more like a bank than it is auto manufacturer, and that changes their beta quite significantly. So I can't think of many stocks I would give a beta of above 3, and I don't go below 4.4. All right, we'll start there next time.